Hi everyone! In this video, we're breaking down the Federal Reserve's most important tools: interest rates, quantitative easing, quantitative tightening, and how all of those work together to guide the US economy. By the end, you'll understand not just what the Fed does, but why these tools matter for markets, inflation, and everyday financial decisions. We'll move through six main sections: the Fed's toolbox, the interest rate levers, how QE works, how QT works, how these tools interact, and finally the key takeaways to tie everything together. Let's start with the Fed's mission and why monetary policy even exists. The Federal Reserve operates under what's called the dual mandate: maximum employment and price stability. Every tool the Fed uses, from rate changes to balance sheet operations, is aimed at keeping unemployment low and inflation under control. The key decision making body behind these tools is the Federal Open Market Committee, or FOMC. They meet regularly to assess economic conditions and set the direction for monetary policy. The Fed's tools fall into two categories. Interest rate tools let the federal funds target range, the interest pays on reserve balances, known as IORB, and discount rate, and balance sheet tools, mainly quantitative easing and quantitative tightening. Rate tools influence short term interest rates. Balance sheet tools affect longer term yields and overall financial conditions. Together, they form the backbone of modern monetary policy. The federal funds rate is the interest rate banks charge each other for overnight loans. The FOMC sets a target range rather than a single number. Market forces determine the actual effective federal funds rate, but the Fed uses its tools to keep that rate inside the target range. When the Fed lowers the range, that's expansionary. It stimulates borrowing and spending. When the Fed raises it, its monetary policy tightens, slowing demand and helping cool inflation. A change in the federal funds rate cascades throughout the entire financial system. It affects mortgages, business loans, credit card rates, auto loans, essentially any borrowing costs. This is a transmission mechanism. Tweak the foundation and the whole structure shifts. That's why the Fed's rate announcements can move everything from the stock market to housing demand. IORB, or interest on reserve balances, is one of the Fed's most powerful tools. By paying interest on bank reserves, the Fed sets a floor under short term interest rates. Banks won't lend for less than what they can earn risk free at the Fed. The discount window, meanwhile, is a backup lending facility for banks. Its rate sits above the fund's rate target and acts as a ceiling. Together, these rates form a corridor that helps anchor short term rates where the Fed wants them. The Overnight Reverse Repo Facility, or ON-RRP, extends that floor to non bank institutions. Money market funds can lend money to the Fed overnight at a fixed rate, ensuring short term rates don't fall too low. ON-RRP also absorbs excess liquidity from the system, giving the Fed extra control when money markets are overflowing with cash, such as after a large stimulus program. Quantitative easing is the Fed's most influential balance sheet tool. During QE, the Fed buys large amounts of Treasury bonds and mortgage backed securities. These purchases increase bank reserves and expand the Fed's balance sheet. The goal is clear: push down long term interest rates, make borrowing cheaper, and stimulate economic activity. QE is typically used in recessions or periods of financial stress. When the Fed buys bonds, investors holding these bonds suddenly have more cash and fewer safe assets. So they start moving into riskier assets like stocks, corporate bonds, or real estate. This is the portfolio rebalancing channel, and it's one of the strongest ways QE boosts financial markets. It lowers credit spreads, increases liquidity, and supports economic recovery by easing financial conditions. Quantitative tightening is QE in reverse. Instead of buying assets, the Fed lets existing securities mature without reinvesting. As these bonds roll off, bank reserves shrink and liquidity is drained from the system. QT tightens financial conditions and usually puts upward pressure on interest rates, especially short term ones. QT can steepen the yield curve, raise bank funding costs, and reduce liquidity in money markets. Because of these effects, QT must be balanced carefully with rate hikes. Too much tightening at once can stress markets. This balancing act is why the Fed often adjusts the pace of QT based on the economic outlook. Interest rates and balance sheet tools aren't used in isolation. The Fed often picks between the two depending on what the economy needs. Rate hikes work quickly and directly. QT works slowly but influences long term yields more powerfully. The mix the Fed chooses depends on inflation pressures, financial market volatility, and how many reserves the banks still hold. Beyond actual actions, the Fed's communication is a tool of its own. Clear forward guidance, signals about future policy, shapes market expectations long before any moves happen. Good communication reduces uncertainty and helps markets adjust smoothly. In many cases, words alone can move markets just as much as policy. Here are the key things to remember. Interest rate corridors. Tools like IORB and the discount rate hold the funds rate in its target range. QE and QT. The Fed uses balance sheet to influence long-term yields and overall liquidity. Communication matters. Forward guidance shapes expectations and can stabilize markets. And most importantly, the Fed blends these tools based on the economy's needs, inflation trends, and financial stability concerns. Understanding these levers makes it easier to interpret Fed decisions and how they ripple through markets, businesses, and consumer finances. Thank you for watching this video on the Federal Reserve's tools.